This initiative is a part of Hiregange Academy, wherein we are creating short videos on interesting areas or contentious areas in GST. This PPT is on the interest computation, which was recently clarified by the GST Council. We will be giving certain small examples in relation to outward and inward supply and how this must be considered. So coming to the interest which is there on interest of ITC, which is wrongly availed, please note that the wordings in the section have been changed by notification 14, and there is a separate rule which has been introduced which is deemed effective from 1st July 2017. First and foremost, interest is at 18%, not 24%, and it is on ITC which has been wrongly availed and utilized. Please note, it is availed and utilized, not availed or utilized. It is applicable from the date of utilization and would be applicable till the date when such reversal of the credit or the payment of tax has been made. So when does a situation fall under the concept of availed and utilized? When the electronic credit ledger balance is lesser than the ITC which has been wrongly availed. So say my ITC wrongly availed is 10 lakhs. Electronic credit balance as on today has dropped to 6 lakhs. The ITC which has been wrongly availed and utilized is then 4 lakhs. Now, how do we identify the date of utilization? Assume that the balance falls in the electronic credit ledger because of the filing of GSTR 3B, then either the filing date or the due date, which means that if you have delayed filing your returns to ensure that the interest is reduced, the impact would not change. It would be the due date or the filing date, whichever is earlier. If you are making any payments using the ITC balance in the electronic credit ledger, that is by way of DRC03 or refund of ITC, and that credit is incorrectly claimed, then when that amount is reduced from the electronic credit ledger, which you can specifically see in the services tab of your after your login, you will be able to identify the date of utilization. So now that we have all the details, that is the date of utilization and when it is considered as availed and utilized, the calculation of interest is only procedural. Please ensure it is done at 18%, and this would be applicable from 1st July 2017. In any situation where you have paid the interest on ITC wrongly claimed, where say you had a credit balance or it was paid at 24%, in these situations, if it is significant enough, you could go for a refund and obtain the refund from the government. So now, what is the manner of calculating this interest for under Rule 88B? Specifically has been provided in relation to the concept of net liability. So net liability basically is netting of my outward and inward credit. The net liability which is there, the interest would be applicable only on that. But please keep in mind that the concept of net liability has been made applicable only for the liability of such period disclosed in such period. Please keep in mind, I'm saying of such period disclosed in such period. If you are disclosing the liability of a previous period in the present month or present liability in a future month, the concept of interest would be applicable on gross liability and not net liability. So just to give an example, the tax liability for the month of July is 1 lakh. The return has been delayed by 10 days. That is, it has been filed on 30th August 2022. In this situation, the tax liability on the net liability which is there is 40,000. The interest will be applicable only on 40,000. That is the cash portion. The interest which will be applicable on any other types of payments, that is payments which are made through DRC03, payments which are made due to proceedings initiated by the department, scrutiny of returns or audit, all of these will be on gross basis. So let's take a scenario wherein the liability is 1 lakh, but out of that 10,000 rupees for which is the liability of July is being paid in December. So in this situation, first and foremost, for the delay in the month of August, which is 10 days, on 30,000, you would pay interest at on the net liability of 30,000. But on the 10,000 rupees, which is delayed liability of July, which is not shown in that month, but has been shown in a subsequent period, for that period for 6 months, there will be an interest at 18% on 10,000, irrespective of a ITC balance being available. So the questions which I mentioned also are in the same manner. In a situation where the deposit of tax in the electronic cash ledger has been done but not utilized for payment, can it be said that the interest is not applicable? No, interest would still be applicable because the payment of tax, that is adjustment of from the cash ledger, is mandatory for it to be considered as payment. Alternatively, you can also refund the amounts from the cash ledger at your will and wish. Taxes paid through other than returns would always be applicable on gross basis. There is a difference and a shift in the concept from the pre-GST regime to the GST regime. So some of the practical situations for interest on ITC, first and foremost is capex with respect to buildings where it may be ineligible credit. RCM and residential dwelling could be said to be ineligible or eligible. This is a disputable area. RCM and renting of motor vehicles more than 13-seater, less than 13-seater. Insurance repairs in relation to such motor vehicle seating capacity. Food and beverage related ITC, health and life insurance. These are generally all the types of ineligible credits that may arise, which can be inadvertently claimed as eligible. When it is done so, then again, it needs to be seen whether balance is available. That means whether such ineligible credit has been utilized for the payment of taxes. If not, the interest would not arise. Next is the section 16 non-compliance, that is wherein the credit eligibility conditions which are mentioned are not satisfied. Say you have not received the invoice or not received the goods and services, then it can be said that you have wrongly availed the ITC and therefore the interest would be applicable. The one of the major non-compliance now of section 16 is the section 16(2)AA, wherein it requires the GSTR 2B of the vendor to be disclosed. There are many taxpayers who are not doing this reconciliation, therefore claiming based on their invoices in hand, not based on the reflection in GSTR 2B. Because now this requirement has been brought into the GST law, this may be very clearly a non-compliance and the interest would apply. So in such situations, there may be a possibility that the credit would be, interest would be applicable. Next is the consumption-based credit, which means upon purchase of goods, it may have been intended for taxable or eligible purposes, but when actually consumed, it is used for exempt or ineligible purpose. In this situation, the department has not clarified from when the interest would be applicable. Ideally, it should be from the consumption, because the activity of it becoming ineligible has happened from the time the intention has changed. Option of claiming credit and not utilizing. These are arising in certain situations where you claim the credit on a situation when you are not clear about the eligibility of the credit. One of the common examples is the Safari Retreats case, where in relation to the capex, in relation to immovable property, also the credit was allowed when it is used directly for taxable outward supplies. So in this situation, the option which can be there is claiming the credit and reversing it under protest and writing a letter to your jurisdictional officer intimating him on the course of action taken. There would be certain persons who may say that the under protest option is not valid under the GST law. There is no option, but this comes under the purview of principle of natural justice. This must be allowed. So to this extent, I feel that option is good because of the fact that if you maintain, say, an IGST ITC balance, due to the law, due to the utilization of ITC, IGST ITC must first be utilized. Therefore, keeping an amount with an option not to claim and not to utilize may not be practically possible. Coming to some of the situations where interest applies under section 51. So the interest for ITC, where it is wrongly availed and utilized, comes under section 50 subsection 3. But these are certain situations where it is ITC, but the interest is specifically applicable under 50 subsection 1. which is your Rule 37, that is your 180-day non-payment to your vendors, Rule 42-43 ITC reversal in relation to exempt and non-GST supplies, and in all these scenarios, the interest which is there will not apply on net liability basis. It will always be on gross liability because the net liability concept comes only in 50 subsection 3. So please keep in mind that 18% is the interest rate for all situations. And alternatively, the net liability concept would only apply for liability of the month shown in the month, but there has been a delay in filing the returns. If you are in any other scenario, the interest would be on a gross basis. The same has been summarized here in a simple manner for your ease. So coming to some of the disclosures and errors which can be considered, which can be avoided, is first and foremost the increase and reduction of liability on account of debit note, credit note. Please ensure that it is disclosed only in the outward supplies and not forming part of ITC. Generally, what happens is in these situations, there will be a mismatch between GSTR 1 and 3B. This could lead to a lot of issues for the taxpayers. There's a possibility of suspension of registration also. Or in the other side of the impact is that the recipient's credit also must be impacted whenever you are reducing your liability. To ensure that he gets his credit, of course, that also the debit note must be disclosed appropriately. Generally, credit notes are disclosed as a part of ITC whenever there is no sufficient liability in Table 3. But to this extent, the department is supposed to allow negative liability in the portal and allow it to be set off. But to this extent, this GST portal is yet to be updated. The other portion is do not club outward supplies under table 3.1a only. Ensure all the bifurcations are made appropriately, that is exports, exempt supply, taxable outward and RCM in the GSTR 3B. This will ensure that the RCM, the interest which is applicable is not applied to the entire value. Say for exempt supplies, as there is no tax, what would be the impact? So in such situations, exports also may be done without payment of taxes. So the credit and the liabilities must be bifurcated completely in the GSTR 3B. Always ensure your GSTR 1 and 3B are matching on a monthly basis to avoid departmental interventions. Reconciliations of GSTR 1 to books, that means before you file your GSTR 1, reconcile your books to GSTR 1. Ensure your 3B in relation to the inward supplies are also matched to the GSTR, to the books of accounts. And wherever nil disclosures are required, that also can be done. To ensure that the values do not change after the GST returns have been filed, ensure you use cutoff dates in your books of accounts to ensure that the values in the books are not dynamic. So this brings me to the end of my presentation. For any queries, any clarifications, please reach out to my email ID on your screen. I would like to thank you for your time and your patience.